Hello, everyone. We are so excited that you're with us again. Every Wednesday, we are here at 11 a.m. Central Time to talk about retirement. And as always, we switch it up a little bit. So this time, instead of having Dave Hall with us, we have Britt with us. And Brian, I want to welcome you to our show today.
Thanks, CR. Good to see you.
Yeah, it's great to have you here. I'm so surprised we were talking before that we've been working together for quite a while. And this is the first time you've actually been on the show with me. And I'm so surprised that it's taken this long to pull you in here.
Well, I won't take it personally, and you're forgiven. So
I was hoping we were just going to have a puppy cam today because I could get mine and you could get yours and we could just share those the whole time.
He's next to me chewing a bone twice the size of his head. So, yeah, at least he's not chewing the couch. So that's a good thing.
Well, Brian, I'm so glad that you're with us. And I want to have everyone know before we get going that I have some special treat because you are actually on a podcast with Dave, one of his revamp of the risk-free retirement show. And you are one of his very first guests on there. So kudos to that. So those who are joining us can catch you on anywhere you listen to podcasts and you can hear more about your story. And I think that's the first thing I wanted to start. But Brian, I know you started, you're a financial consultant. You've been in there since 1983, helping others protect and grow their wealth. The one thing I wanted to start talking about is I think you were 17 when all this began, right?
Oh, boy. Yeah. So I started working in the back office of a mutual fund company in New York City when I was 17. And I was still in high school, obviously. And then from there, I stayed with that company for when I started college, and then eventually they sponsored me to take the broker's licensing exams, and I started while I was still in college pursuing a degree in economics. I started building a business where I was advising teachers on their 403B accounts for the Archdiocese of New York. And I had an in because I went to an all boys Catholic high school and I knew all those teachers. So I went back to them and started bringing them lunch and doing kind of like a lunch and learn meeting in the conference room, if you will. And that was kind of how I started, was just really advising these teachers on what they can do with their tax deferred money. This was back in 1986, actually, not 1983, but 86. And then from there, got involved with another company in New York City that I became a manager at a very young age, had about 200 advisors under me, and basically built a sales force of financial professionals, again, specializing in mutual funds. Because you got to remember, back in the 80s, mutual funds were cutting edge. Like that was a new thing, right? Because before mutual funds came along, the Investment Company Act of 1974 is where they were built, but before they came along, it was individual stock and bond selection, and that was it. That was the extent of money management, as you were a stock picker, right? A stock broker, if you will. And then mutual funds came along and gave people the opportunity to have professional money management, diversification, transparency, an investment policy statement that actually showed how the money manager was going to invest the money. And so it was really cutting edge to be able to offer people mutual funds and access to professional managers. So I stayed in management for about 5 years. I moved to Chicago from New York City with the company I was running offices for in New York. They wanted to build into Chicago. That didn't work out. It was a blessing in disguise. And I joined Lehman Brothers, the investment bank. And if you remember, it was Shearson Lehman at one point, but Lehman always kept their autonomy as an investment bank, and really started to build an asset management practice during those years. This was in the late 80s, early 90s. And that's really where the business I run today on the asset management side across the country, that business started at Lehman Brothers, really, right around 1990. And so what's interesting, though, is when I started out at Lehman, building individual portfolios for investors all over the country, we just worked over the phone. Very rarely did we meet our clients in person. I would say probably for the first 15 years of my career, the conversations when I would call people up would go something like, "Hey, how's it going? How are the kids? How's the business doing?" Great. And then once you got down to it, it was, "Hey, okay, how much money did you make me?" Like it was an accumulation conversation, right? They wanted to know, how do we do compared to the S&P? How are our stocks and bonds doing in the portfolio? So that went on. And then I would say about 15 years or 16 years ago, and my math might be off because I lose track of how long I've been doing this, but the conversation started to change maybe 15, 16 years ago. Instead of them saying, hey, how's it going? By the way, how much money did you make me? I started getting questions like, hey, what if I retire and never work again? How much money can I spend every month? How long will it last? What will be left over when I die? What's the inflation rate that we would assume on that? And what about taxes? And suppose I end up in long-term care at some stage. So that's a completely different relationship than, hey, how much money did you make me? So, I kind of changed with the times. And back then, I changed my practice over from purely a wealth management practice really to a financial planning practice with tax, asset protection, long-term care, and estate legacy with as a focus. So I still manage assets all over the country, but honestly, a lot of those people have been with me for 25, 30 years, and it's just legacy relationships. The focus today, and at least for the last 16 years, has been on building financial plans and really being an architect, building blueprints, as Dave and I call it, spreadsheeting out the rest of your life, right? That's really what we do today. So that's kind of been the evolution of my career. And in the middle of all that, in 1997, I moved from Chicago, the tropical climate of Chicago, to San Diego, and I've been hard pressed to move from San Diego since 1997. So I'm still in San Diego, and enjoying it and feel blessed to be here. So that's kind of the story.
Well, thank you so much. And for those joining us live and on replay, you can also catch the rest of his story also on the podcast. And another great thing I wanted to bring up also here is you are doing a webinar with Dave, and you do this every month.
Yep.
And this one is coming up on January 25th. So I will be putting that in the comments, and you can sign up to join Dave and Brian as they talk about this, exactly what you've been talking about, kind of the architect putting this plan together. And I love that you use the word architect as you're building this blueprint, because I think that's really what it is. And the reason that I love working with you, Brian, is because you are in the business. I refer to it as education, because if people aren't getting the proper education in retirement or headed toward retirement, all kind of things can happen. And I love the fact that you're helping people put these plans together and build it with them, and not just saying, hey, I'm going to do this, and then you're just going to show up.
I'm glad you brought that up, because I think anyone listening to this can relate. Most relationships in the financial services businesses are upside down. They start at the wrong end of the process. They start with product and solutions, and then eventually maybe they talk about financial planning. And I certainly did that for many, many years, right? As I said, most of my focus was just on stock and bond portfolios and accumulation. And a lot of people say, well, I have a financial advisor. And I think it's important to define that relationship. If you truly have a financial planner, that means that you didn't do anything. You didn't buy a product, invest in a stock, bond, mutual fund, annuity, life insurance policy until you built out a full blueprint and mathematically proved what you actually needed. And I think that's what Dave and I really are passionate about, is truly working from the top down, starting with the 30,000-foot view, understanding where all the assets are, how they're going to be affected if taxes change, if a long-term care event occurs, if a major stock market correction, I should say when a major stock market correction happens again. We start from that perspective purely as architects, building blueprints. Once we build the blueprint and we do our job as architects, and we really define what this picture is going to look like, then we can talk about stocks, bonds, mutual funds, annuities, life insurance, long-term care. That's fine to get into it then, but most relationships out there are upside down, so we feel like we're right side up.
And I really appreciate that. And Brian, I know I've got a lot of folks on here that are on here to ask questions, but what we're going to do is we're going to dive through a series of what we call the retirement Q&A. So what we're going to do is I'm going to throw some questions at you, and I'm just going to have you answer those. And we'll work our way through these. And I'm going to invite those that are here with us live to go ahead and submit their retirement questions if they have any as well.
Right.
And we'll take the next about 20 minutes or so here to go through some of these. So Brian, if you're ready, I'm going to throw some questions at you to get you going.
All right. Hopefully I know the answers.
Okay.
I promise if I don't, I will tell you I don't know the answer and we'll move on. I'll say pass like on those game shows. Pass. Pass.
Perfect. I need a pass button on here. I need to get that.
Yeah, I
going.
want a pass button. That'd be good. Okay, go ahead.
All right. So my first one here is from Thomas. What, if any, are disadvantages of Roth IRA accounts?
Okay, that's a good question. So Roth IRAs, obviously we know what the advantages are, right? They're going to grow tax exempt, federal, state, capital gain exempt, as well as any money you take out of a Roth is not going to be used to calculate whether or not your Social Security is going to be taxable. So we certainly like Roths. The disadvantage is, number one, you are funding it with after-tax dollars, which means you have to pay taxes today at today's rates, right? So, well, why would that be a bad thing? It would be a bad thing if you were either funding a Roth or converting your deferred money into Roths. It would be a bad thing if, when you get into retirement, your tax bracket is much lower than where it is today. That means you basically paid a higher price to the federal and state governments on taxes due than you would have paid if you would have waited, postponed, and maybe paid at a later time when your, let's say, income might be dramatically less. Now, having said that, that's kind of the old school reason that most CPAs would advise their clients for the last 35, 40 years, as long as I've been in the business, to fund regular IRAs, right? Because they're saying, hey, today you're making a lot of money, but when you're retired, you might not be making that much money. So your tax bracket should be much lower and you'll get to postpone a higher bill and be able to take money out later on when it's cheaper. The challenge to that theory is history. Right now, we're in the third lowest tax bracket of 88 years. Just a little aside story. So in 1974, when IRAs were invented, my dad made 160,000, 150 something thousand bucks, right? He was a total rock star. Never graduated from high school, got his GED on a Navy ship, came out of the Korean War, and was just absolutely phenomenal at building customer relationships and selling. He ended up selling raised flooring for mainframe computer rooms. And back in the day, those mainframes were the size of a Volkswagen. So you needed special flooring so it wouldn't fall through the floor, literally. So anyway, at that point, my dad was in the 70% federal bracket. We lived in New York City. He was in an 80+% if you counted the 10 that he had to pay to city and state. So when he retired, he was in a 20% bracket. So an absolutely brilliant move, right? But keep in mind, yes, he made less money in retirement, but that was not why he was in a 20 bracket. He was in a 20 bracket because the max rate went from 70%, which my dad was at, down to about 37% or 34%. So it wasn't just because he was making less money. It was because taxes cratered. Just think Ronald Reagan, right? Came in and, Reagan was at the 94% federal bracket when he was a movie star making $1 million or the equivalent of $1 million a year. And he was at a 94% federal bracket in 1944. I'm trying to do my history in my head there. So he lowered rates dramatically. And at one point, Reagan pushed the rates down into the 20s, was the highest federal rate you could be at. I think it was 28 or something like that. So anyway, the downside of a Roth is if you are wrong about the future of taxes and they end up either staying the same, which means you may be in a lesser bracket because you're going to make less money, or they go down, then you would have been better off not doing a Roth at all. Our belief, of course, is your risk of taxes going down is minuscule compared to your risk of them going up dramatically while you're in retirement. Even if you're going to make less money, your tax system may be much more expensive, and you still would have been better off doing some Roth. Not all, and we'll talk more about that.
Great, great. Thank you so much. That was a great answer. All right. So again, if you're joining us live or on replay, again, if you are on replay, you can submit your questions at our website, retirementriskadvisors.com. Now, if you are here live and you want to submit your questions, go ahead and get those, and we'll try to squeeze those in between our other questions I have here for Brian. All right, Brian, let's get Frank's question on the board here. Frank is saying U.S. Series I savings bonds are currently paying 7.12%. Do you see any downfalls in buying some?
Tell Frank I'm going to send him about $1 million and he can buy that bond for me. But unfortunately, it doesn't exist. What Frank probably is looking at is an older Series EE bond, which absolutely was paying north of 7% and will pay that interest rate until it matures. A 20-year Treasury bond today is at about 3.3%. Now, having said that, that's way better than a savings bond is at 3.3. Treasury bond is at 1.3 for a 10-year, and I think 1.8 for a 20. Don't quote me on that. You can look it up. The point is, if you're going to buy a federally backed bond with zero risk, if we can define risk, right? Zero risk because the federal government's backing it up. Savings bonds are very advantageous over Treasury bonds. And as I said, they're paying about 3.3% for a 20-year maturity. So the advantages of a savings bond would be real much better rate of return than a Treasury. B, the interest is going to be deferred until you pull it out. And C, they are just good to kind of buy and hold on to and forget, which is why they're called savings bonds. So people tend to keep them, right? They tend to not trade them. And luckily, because you can't just call up your broker and say, sell my Treasury bond. You have to actually sell it through a government facility to be able to do it. So they're not as liquid as a municipal bond or a Treasury bond, which can be sold almost instantly. But again, that's 7%. I have a safe with a stack of Treasury bonds that relatives gave two of my three boys. I don't know, my youngest one got gypped, but the two oldest ones got Treasury bonds. And I was looking at those recently. I had to send somebody a copy of my passport for something, and just for some thing I was doing. And I picked up the bonds, and sure enough, they were like 7.3%. I'm like, what? But those are, they're at least, let's see, my oldest is 28, my middle one is 25. So the 28's got another 2 years of interest at that rate. My 25's got another 5 years of interest at that rate, and then they stop paying interest. That's it. So you gotta get rid of them when they mature. Another little tidbit about Treasury bonds. When they mature, if you don't go cash them in, you're not getting any money on your money. They're just going to be worth whatever they were worth on the maturity date.
And I appreciate that answer. And I'm going to jump down because I know we've got a few more I'm going to try to squeeze in before our time's up. So let me jump over to Eric. Eric is wondering, I am self-employed with no retirement savings. Can I set a defined benefit plan for just me and fully fund it in a couple years?
So I'm gonna hedge my answer. I believe it is yes. I would talk to your tax professional. There's a lot of little innuendos in the tax law when it comes to defined benefit plans, rather than defined contribution plans like 401ks. There's a little easier to figure out. But I'm going to say yes to that question with a disclaimer. Don't quote me on it, but I think you can. And then of course you probably already know, as a self-employed person with no retirement plan, you could do a solo 401k profit sharing plan, which will allow you to put about $64,000 a year away if you wanted to. But defined benefit, you can put serious money away. I mean serious money, because it's no longer restricted to the contribution limitation. It's all about how much money you're trying to have when you quote retire. So you take that dollar amount and you work your way backwards to say, how much would it take for me to get to $1 million by this age? I'm using that as a sample number, and the contributions can be massive. So talk to your tax professional to confirm that you're able to do it, but I believe you can.
One of the reasons I put this in here, Brian, is because I wanted to let people know that they can still make time for their retirement, so depending on where they are in life. And I really wanted to put that out there so you could understand that, yes, we need to take action, but yes, we can still do things. I feel like Eric in this case was just saying, I don't think there's any hope for me. Is that a possibility? And you're saying that, yeah, there's still a possibility.
Sure. Yeah. And again, for Eric, I mean, IRA, for solo 401k, solo 401k slash profit sharing plan, and also defined benefit plan. Now, there's some disadvantages to defined benefit plan once you build them. Once you come up with that dollar amount you're trying to accumulate by a particular date when the plan matures, you're pretty handcuffed to doing it. So if you have a fluctuating income, like a lot of sole employees do, where 1 year may be huge, the next year is down 30%, the next year's up 30%. There are some risks to doing a defined benefit plan because you do have to pretty much fund the plan the way that the designer sets it up for you. So talk to your CPA, and then he'll probably refer you to, or she will probably refer you to a third-party administrator that they know who administrates these defined benefit plans.
All right, Brian. So my next question, and we're going to need a little backstory on this one. This is from Bethany. She's saying, what about Roths being in the tax-free bucket? Now, most people watch this show may know about the three bucket system, but maybe just give us kind of a brief overview of what she's talking about before we dive into this.
Okay. So real simple, three different buckets that we refer to as planners. And Ed Slott, the famous CPA, I don't know if he's as famous as Dave Hall, but he's famous too. But he says there's three buckets in your life, and that's all you need to understand for financial success. Tax me now, tax me later, tax me never, right? So that's taxable, tax deferred, or what I like to call tax postponed, and tax me never, which are going to be things like Roth IRAs, Roth 401ks, Roth conversion accounts, cash value inside of permanent life insurance. Those are tax exempt no matter how you look at it. And also, what's the definition of tax exempt? It means no federal, no state, no capital gain. And the money, when you pull it out, does not get included in the provisional income formula, which is the formula the IRS uses to determine whether or not they're going to tax your Social Security, 85% of it, 50% of it, or none of it, right? So as far as a Roth being in the tax-free bucket, it is. I'm not sure if I understand the question. What about Roths being in the tax-free bucket? They are the tax-free. That's it. They are considered living in that bucket.
Good. Perfect. Thank you very much. All right, I'm going to squeeze a few more in here. Again, if you are watching live, we appreciate you being here and participating with us today, and especially learning, because we've got Brian stepping in for Dave today and really giving us some great education. And so with that one, I want to bring up Freddie's question. Are there income requirements to contribute to a Roth?
Yes. So if you're going to be contributing directly to a regular Roth, meaning not a Roth 401k, the limitations, the income limitations, when we say requirements, I'm assuming you're talking about limitations, are exactly the same as IRAs. And again, it depends on if you have a plan already at your employer or if you don't. So just look up IRA limitations 2022. It'll pop right up on the screen. Just to save time, because there's a whole bunch of different things in there. But the rules are different. Number one, if you're filing single versus married, right? So you got to look up those numbers. But then also for both single and joint filers, if your employer is offering you a plan, then that messes with things a little bit too. So just look that up. But the answer is yes, there are limitations, and you can be what we call phased out, which means you make too much money and therefore you are not eligible to do an IRA or a Roth for that matter. But just remember, Roths have exactly the same rules as IRAs, except they are tax-free when you take them out, and there's no required minimum distribution. That's one difference, where it's not exactly the same because you've already paid your tax on it. So there's no RMDs to get you to pay tax, right? So that's it.
And we did talk about this three bucket system. So I want to bring up this other question now that we've already kind of given us a base of this. So let's see if I can get my question to pop up here from Kathleen. Why would you not want 100% of your money in a tax-free bucket?
Oh, this is a great question. I'm glad it was asked. So you would think that if you believe taxes are going to be dramatically higher in the future, 100% of your money should be in that tax-free bucket, or let's say inside of cash value life insurance, which is another beautiful tax shelter that even though it tried to get shut down in the 1980s, they couldn't figure out a way to do it. So we use it today as well. But why would you not want to put all your money in the tax-free bucket? And this is a little kind of a little secret that we teach in our 4-hour class, The Changing World of Retirement Planning, that basically we want to be able to play the chess game with the federal government as best as we can. And there's something that you may know called the standard deduction. And that basically is so poor people don't pay taxes, right? That's what it really is. So if you're a married couple, let's say, you make 25,000 bucks as a married couple, the government considers you poor, and therefore you'll pay no taxes on that $25,000. And it's about half of that for individuals, right? Single filers. So here's kind of a neat little trick. If you can engineer, and this is what we do in our plans when we build the blueprints, if you can engineer the amount of money that you have in your tax deferred bucket to be an amount that when you get to 72 years old and are forced to take required minimum distributions, your distribution will not exceed your standard deduction, which means in theory, in practice, you've deferred paying taxes on earnings and you figured out a way to pull it out 100% tax-free because the taxes you should have paid on the required minimum distribution were completely negated because of the exemption, right? The exemption that we all get. So in a perfect world, we fund your tax deferred bucket up to the limit of where, when you're 72 years old, we can sneak it out once a year, take that RMD and pay zero taxes on the RMD because of the personal exemption or the standard deduction. So I'm calling it the old thing, the standard deduction, right? So the key here is really engineering each of your buckets, the taxable bucket, the tax deferred bucket, and the tax-free bucket, all need to be engineered to what we call MIB. That does not stand for Men in Black. It stands for mathematically ideal balance. And there really are mathematically ideal balances for all three buckets. But great question. Thanks for asking that.
All right, Brian, I'm going to throw one more at you before we go. We're just about 2 minutes short here.
Okay.
So let's get one here from Michael. Do you consider stock investments part of the tax deferred bucket since you do not pay tax until the stock is sold?
So yes and no. I mean, technically, if it's not paying a dividend, it is a tax deferred investment, just like a savings bond, for example, would be considered a tax deferred investment because you're not paying any you're not getting a tax bill every year from the federal government on your savings bond. So yeah, technically it is tax deferred, but we usually don't include it in the tax deferred bucket when we build a plan, only because there's no RMDs. There's no income limitations, So yeah, I mean, technically we put it in the taxable bucket because you will pay tax on it when you pull it out. And if it pays a dividend, you're going to pay taxes immediately, right? So technically we put it in the taxable bucket, but your point is well taken, that it is also a potentially tax deferred investment if it's not a dividend paying instrument.
Great. Thank you so much. And you also talked about that 4-hour class. So I want to bring this up here to let everyone know that, yes, you are helping and teaching Dave in this amazing Changing World of Retirement webinar. The next one we have is January 25th. And I believe it's like 11 a.m. Eastern. So I can't remember what time that is. It sounds like it's 8 a.m. your time, which is, are you awake at that point?
I force myself to be awake. I'm awake. Yeah, yeah. It's 8 to noon for you West Coasters. And
so, I'm just appreciative that you are part of that with us. And it's so great to have you as we're here with the Retirement Risk Advisors, as we're going through, because that 4 hours really is just packed full of great advice, but also we're really looking at, like you referred to here, is this 3-bucket system. And before we go, Brian, tell me just anything about that class that really inspires you as before we sign off.
I started teaching that class live at UCSD in their business school in 2015, and I taught it for just about 4.5 years till COVID hit, and then they didn't want to do live class anymore. And really, teaching it live for all those years just gave me just great pleasure to see the light bulbs in the room just going off. Like, you're in a room live with people, and as you're sharing information they've never heard, just like that one little, tidbit I gave about having the right amount of money in your tax deferred bucket so you can take it out tax free. It was just so cool to be able to see people light up like, oh my God, I never knew that. So I will tell you that if you do attend that class, you will be blown away. It is a fire hose of information. And, just one little secret, or I should say a second secret. I'm giving away all my secrets. You might not have to the class, but if you can get your Social Security to be 100% tax-free, it'll extend the life of your assets 5 to 7 years. So in that class, we actually teach you how to do that. And everything on the chessboard has to be positioned correctly for the federal government to not be able to tax you on your Social Security. So just stuff like that. But we get deep into asset protection, long-term care, tax protection. We really do get into a lot of different things in a very, very short period of time. When I taught the class live at UCSD, it was 6 hours over 2 weeks. We did 3 hours per night on a Monday night, let's say. So now we crammed it all into 4 hours for the advanced students that you all are. So hopefully we'll see you there.
Yeah. So once again, everyone, that is January 25th. And so we're looking forward to having you there. And with that, don't forget that Brian was on the podcast as well. So again, if you go to retirementriskadvisors.com, you can click on the education and go down to Retirement Risk Show. And you can also hear Brian's story there as well. And you can even learn more about Brian on the advisors page. That's one thing that's really important for us. And I think it's a really important piece for us to understand that, again, as we talk about retirement, we're talking about education, making sure we're getting ourselves educated. Brian, you've already shared so many great secrets. I'm hoping we're going to be able to have you come back on the show at some point.
I gave all my secrets away. There's nothing left to say. No, I'll be back. Sure. Anytime. Good to be here. All right.
Well, Brian, thank you so much. And for everyone else, thank you so much for being here live. And for those on replay, thank you so much. If you have additional questions, retirementriskadvisors.com/contact us. You can submit your questions, what we can use for future shows. Have a great day, everyone, and we'll see you again soon.